Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus coming at you right now, and I'm super excited about this episode. Once every probably 10 episodes or so, maybe 12 or 15, we have a guru in the making on the show. as am I, by the way, very much so. I think. Basically, it's super nice to have somebody on the show really at any stage in their path, because any of those stages in the path can be really informative. But when you have somebody that has a small portfolio, has done a few deals, and in this case, maybe a little more than just a few deals, but wants to scale up into bigger unit count assets, right? So, think more like 40 to 80 units, maybe even over 100 units. And that's really what this show's about. Like when it comes down to it, the overarching theme of this show is leveling up from where you are to where you want to be. And I make the assumption that people that are listening have seen the magic of multifamily and understand why multifamily is so wonderful and want to be in that space. So I've got John Rickgarn on the show with me today, and John has a total of 14 units. So a little rental portfolio. Not little, right? It's all relative. I don't mean to invalidate that at all, because it takes a lot of work and effort to get to that. And you're in like 5 different markets, aren't you, John?
Yeah, across 5 states, correct.
Yeah. So that's a lot of work and getting that going, and you've learned a lot. I know you have, because just doing those deals takes a lot of work and a lot of learning. So, but by the way of an intro, John started in 2016 with a vacant 4-plex by pulling money out of a Roth IRA. And in 2019, left his 12-year corporate sales job to concentrate on real estate and passive income. He's been married to his best friend and better half since 2008, and they have an 11-month-old miracle child son. What's the miracle referred to?
Miracle is basically my wife and I tried for years to have a child, and 5 miscarriages. And long story short, we had worked with fertility doctor, and without going into the medical jargon, just said, with your histories, I don't think children is going to be in the cards. You're going to have to look at adoption or surrogacy or something. So we're like, okay, we just accepted it. And it's like, all right, it's not in the cards. Yeah. And out of the blue, then my wife was pregnant, and it's like, all right, let's not get our hopes up. We've been down this road 6 weeks tops, miscarriage, and ended up checkup, everything was fine. And then September 8th of 2021, our miracle child was born. So,
oh man, what that is a miracle. What an awesome story.
Well, thanks.
Congratulations on that. And it sounds like you guys went through an awful lot to get to that point. Man, that's big stuff. So it makes apartment investing look a little bit smaller in comparison. But so John, I'm really excited to dig in and almost kind of do a little mini mastermind or coaching session with you. And just see kind of where you are, what your strengths are, and what you want to be doing in this space, and talk about how to get you there, and how to keep moving the ball forward. But before we get into that, if you would just share with the listeners and myself kind of your backstory. I hit on some major points. You were in corporate sales for a while. What industry were you in?
Sold mainly started with office equipment, copiers and printers, but also expanded through phone systems, IT services, technology products as well. So
wow. Okay, cool. And those positions can do pretty well, right? I mean, you can get into a golden handcuffs.
Oh yeah.
situation there pretty easily, where you're chained to your job because the pay's so good, right?
Yeah. Well, and then the other, kick in the teeth, if you will, for the longest time, we were an employee-owned company. So we had a, employee stock ownership plan. And I looked at it. I still remember when the company I previously worked for got bought out, and employee-owned, stocks go up and additional stock compensation every year. It's like, I'm home. I'm going to stay here till I'm retired. And then I still remember driving down Highway 212 when my coworker called me. It's like, yeah, did you hear they sold the company, and they sold to a private equity company? So there goes the ESOP. Between the ESOP going away and then they started changing the commission structure, my compensation was cut in half from 2015 to 2016. So that was really kind of the kicker of, there is no such thing as a secure job. And just because things are going good right now doesn't mean it can't change. So
such a good point. And, people think that their job is security and that starting their own business, it would be risky. And let me tell you, if you can start and build a viable, healthy business that is supporting itself, supporting the business, supporting you, and you own it, there's nothing more secure than that. Now, are you exposed to things like market shifts and things like supply chain issues? I mean, stuff that's out of your control, and absolutely you are. And that's why you need to be so smart about what you're doing. But I love that point, because look, anybody with a job, the bottom line is they could be packing up a box of files and leaving the office today or tomorrow, when they thought they were set for the rest of their lives. And that's really sad, and it's scary. But it happens. It unfortunately, it happened to my mom in her last job right before she retired. They just, I don't even want to get into it. It's painful. It's it's painful stuff. So, all right. So talk about a little bit about what you did. So did you already have real estate on the radar at that point?
Sort of. So, and I'll take a little step back, and it was actually I call it my aha moment. It was late 2014. My wife actually, she left a toxic work environment. I, support her as no paycheck's worth your health. You got to get out of there. So she quit her job, and she was paid very well as well. And she decided to go back to school full time to become a college professor. She wanted to get her doctorate degree. So I still remember sitting there. It's like, all right, down to one income, got to start thinking, sell more copiers, or can we sell some stuff at eBay? Are there other, jobs, so to speak? That was the only additional stream of income I knew at the time. And just was thinking all this. And it just kind of hit me like all of a sudden. I was 31 years old at the time. If I had, worked my butt off for the next, relived my entire life, that 31 years, 40, 50, 60 hours a week, I still want to be at the arbitrary retirement age of 65 that everyone talks about. And then kind of had my second aha moment of, well, what if I don't make it to age 65? Because another part of my backstory is both my parents passed away of cancer by the time I was 16, and they passed away in their 50s. So it was just, I don't know, just kind of really hit me. It's like, well, there's got to be more to life than just working a W-2 job, working your tail off for highly taxed earned income, as I later learned out, and shoveling all this money into a retirement account. And there's no guarantees you're going to be around at age 65 to enjoy it anyway. So, and then I was kind of at the unconscious incompetence of, I didn't know what I didn't know. Right. So did a deep dive into reading, podcast, everything I could find, real estate, business, seemed to be kind of the go-to of what a lot of other millionaires use to grow their wealth and income. Yeah. And with my job, I was on the road anywhere from 100 to 200 miles a day. So it's like, well, let's kill that time with listening to podcasts like yours. Nice. And then it just, I don't know, learned a little bit more and more about real estate. And then, summer of 2016, I don't want to say the perfect property, but one that fit everything I was looking for, hit the MLS and put an offer. They accepted, and that's kind of how my real estate investing journey started.
It's awesome. Did you have up to that point, did you have any examples or mentors or anything like that that were doing what you wanted to do?
I wouldn't say any mentors per se, or like not someone I was working with personally. I connected with a lot of people on LinkedIn and listened to their podcast or YouTube channels. So I mean, if you call that a mentorship, maybe
it is. It's digital mentorship. It really, really is. Like that's what this podcast is too. So
I connected with a lot of people. The biggest thing was I wanted to find a property. Met the 1% rule. That obviously the monthly rents would be about 1% of the purchase price, and I wanted a newer property and not have to worry about foundation issues or asbestos or anything like that. And all things came on the MLS. It was actually a fourplex. And of course, price tag $300,000, 25% down payment. A lot of people are like, well, where in the world did you find the down payment for that? And I just always remembered a quote from Robert Kiyosaki: don't say I can afford it, ask how can I afford it. And just from, little nuggets I picked up along the way, our financial advisor even said, well, you've had this Roth IRA since you've been 19. Did you know you could take out your contributions tax free? I'm like, nope, I didn't know that. So that was pretty much the bulk of the down payment for a fourplex.
Beautiful. That's a great way to start. That's a really solid start. And you went, I love that you went right into rental properties. You went right into multifamily. It's not commercial multifamily, as everybody probably knows. It's 5 units and up makes it commercial. But in some ways, there can be advantages to not being commercial, mainly that you have access to owner occupied loans if you wanted to quote unquote house hack it, right? As they say on Bigger Pockets. So, okay, cool. So, that's where was that fourplex?
Right in my hometown, Marshall, Minnesota.
Yeah. So we were talking offline. So John is from Southwest Minnesota, which is near South Dakota and Iowa, you said, right?
Yeah. I just throw out Home of Schwann's ice cream and Red Baron pizzas. That always seems to kind of get people's attention or understand what Marshall is.
Okay. Got it. Yep. So, okay, cool. So nice hometown play, got you going in the game. And I mean, it seems to me like, were you nervous? Like there had to have been some nerves or I mean, it's a pretty fearless thing to do. I think, especially without having somebody hold your hand, it's pretty fearless. So what were your feelings about it?
There was a lot. I think originally, I mean, going from, learning about everything to actually doing it. I mean, obviously was a big transition. At the time I was leery of, buying this fourplex, it's vacant. It doesn't even have an income stream from day one. But one unit was pretty much ready to go. And about 2 weeks after we bought it, we had one husband and wife couple that need to move in like ASAP. So it's like, well, okay, right off the go, we can get one in there. And there's a few, touch ups and upgrades we wanted to put in. It's like, well, might as well do that once vacant. But the thing I've really liked about it in hindsight, yes, it sucks getting a vacant property. You don't have income, but you're not inheriting a problem tenant either.
Yeah, exactly. And our first commercial multifam was a 12 unit that a lot of listeners have heard about, and it was half vacant, and the other half of those tenants, only half of them were paying rent, and the rent was super low. It was all month to month, so we got everybody out.
Yeah.
Like we went the other way. We went away from the income so that we could massively improve the property, head to toe, TPO membrane roof down to new mechanicals and windows and floors. I mean, we really went all out on it, and did great on it. It was a real successful project, but there's some advantages to picking up vacancies, right? Like if you're doing let's scale this conversation up for a minute. If you're doing, say, 100 unit, a community, right? You're basically, and you're doing a value add, you're repositioning. So you're going to go in and remodel all the units, as they turn over. Well, let's say you're 95% occupied. You have to basically time all of that labor with people moving in and out.
Yeah.
As opposed to maybe you're 60% or 70% occupied, you can get a really good head start on all of your remodels and get proof of concept in place with your target rents in a much more efficient way. So vacancies can be good, I guess is what I'm saying. And not something to necessarily kill a deal over if you run across a huge vacant property. Cool. So kind of, so at this point you're out of your job. You're doing this full time. Wife's in college, or what, post grad, right?
Teaches at the college now, but yeah.
Yeah. So there you go. So take us from there. What's happened since then?
Sure. So yeah, like I said, start with a fourplex in 2016. Then actually got two additional properties before I left my W-2 job, a duplex about 70 miles north of Marshall. That was actually an off-market one. And then a vacation condo in Arizona that was also off-market as well. The only short-term rental I have in our portfolio. But then after I left my W-2 job, and kind of around the time right when I was leaving, because right, wrong, or indifferent, banks seem to like that W-2 income versus self-employed income. Did get two single-family turnkey properties in Birmingham, Alabama. Early 2020, also got a single-family home in Memphis, Tennessee, which that market's just kind of taken off. I think everyone knows about it. And then last acquisition was a duplex, again, off-market in Davenport, Iowa.
Yeah. How are you sourcing? I'll call them one-offs, right? Like,
sure.
The one in Memphis, for instance, like how are you finding those, and what's your strategy in going into those markets when you buy there?
Sure. So kind of my strategy is I actually work backwards. I first look at, the markets, like, is it a good market? Is it growing? Is it diversified with the employment base? What's the median income? Do purchase price, rents, et cetera? That's always what I first look at. Second, then I look for not only a great property manager, because they can really make or break your investment. Huge. I always have in my back pocket at least one, if not two other additional property managers. So if one goes, retires, moves on, isn't a good fit, whatever the case may be, or files for bankruptcy, which I had this year.
Oh, wow.
Always have another one to work with that. Okay, company A's not working. I can bounce this off to company B because that's probably the biggest thing I've heard from so many out of state investors is so many of them are like, oh yeah, I got this great property manager or turnkey company or whatever. But if you ask them, it's like, okay, if something happens, do you have a plan B or another property manager lined up? I can count on one hand the number of people that say yes to that question.
Sure. Man, you're touching on something that's so key, and that's the property manager piece. And as you are considering a market or considering an individual property, having a property manager in your back pocket that can run rent comps, that can tell you, forecast budgets, tell you about the area, crime, the tenant base, like, a good property manager in a good solid market that knows the market, they're going to be so key to you in your acquisitions process. And I think people overlook that. Not only that, they can actually be sources of deals.
Exactly.
Yeah. I mean, they have their finger on the pulse of their portfolio and these properties, and they know usually before anyone else or with anyone else that owner's thinking of selling. So networking with property managers is not something I've necessarily really hammered on the show a whole lot like I have on some other stuff, but it's key, man. Like, I'm hammering on it now.
Sure. Yeah.
It's so important. And like you said, it's make it or break it when it comes to the execution of the deal and the business plan. So,
yeah. Well, kind of like you just said with make and break, and like, another market a lot of people talk about. I do love the Kansas City, Missouri market. I really do. I visited there a couple of times, but I really haven't found a phenomenal property manager that I can say, yep, I want this individual or this company to manage the properties. And hence why I haven't really attacked it very much since then.
Interesting. Kansas City is, if we were working together on a, in a formal coaching setting, and you were looking at scaling up and, moving into larger asset class, and you were looking at markets, Kansas City's a market that I would look at. And
okay.
I have actually a close friend, Brad Lancaster. Shout out to Brad. I love you, man. He actually was one of my mentors when I first got started in single family flipping.
Okay.
And that was years and years, 14 years ago. And now he's still doing a lot of that and wants to get into multifamily.
Okay.
And he happens to be from Kansas City.
Okay.
And having some ties to a market, like, you bought your first property in your home market, which makes a lot of sense because that market like the back of your hand better than you'll ever know any other market.
Right.
And so anyway, I did a little bit of looking into Kansas City, and the great news about Kansas City is that it is a classic example of a cash flow market where stuff is very, very affordable compared to the amount of rents that are coming in. So you're talking about higher cap rates, and just better metrics for investors if you're raising capital. And on top of that, it's got some growth. It's not like this crazy Austin or a place like Salt Lake City, a place like that. But it's, especially certain areas are growing nicely. And so, it's definitely a market that I wouldn't give up on. If I'm in your shoes, I think it'd be fruit. There's a lot of inventory there too.
Okay.
Yeah. So, okay, cool. So that kind of brings us up to date on all the properties that you acquired. What, I saw in you have a written goal that you want to get to 10,000 a month in passive income.
Correct. Yep.
Yeah. So
and that's 10,000 net after, property taxes,
all that stuff.
Yep.
Pure profit, 10,000 pure profit. I get it. So what are your thoughts on getting to that point? I guess, in the 1 to 10 scale, kind of where are you in that as far as getting there? And then what are your thoughts as far as moving towards that?
Sure. 1 to 10 scale, I'd say kind of right in the middle. Really did well the last couple of years. Obviously, we've seen nationwide, cap rates get compressed, property values just skyrocketed. So I've kind of taken a step back to reevaluate. As far as getting there, I've looked at, my portfolio. There isn't anything that I want to sell or 1031 exchange or anything like that, but have started to entertain. It's like, well, even with higher interest rates, it might make sense to do a cash out refinance or even a portfolio loan to pull out some additional equity and, put some additional dollars at work. I've also started looking a little bit more as in the passive investing on the syndicator side. I've worked with a few syndicators where, okay, I don't have $5 million capital to invest in an apartment complex or whatever, but I can invest, passively, be the funder, so to speak, and kind of learn from them and collect a paycheck. Yeah, I might not get as much of the upside, but definitely get a little education along with the passive income. So
yeah. Let me ask you something, and just for pondering, I'd love to get your thoughts on this. But let's say you could wave a magic wand and could have a portfolio that has 2 or 300 plus unit communities in it. Is that, and you, by the way, you're the GP in this situation, so you're the operator here.
Okay.
And so they're your properties. Of course, you have partners. You don't necessarily own all of the pie, but you own a big chunk of the pie. Is that model something that you would be interested in? And not even can you see yourself there? Because remember, we've got the magic wand thing. So
sure.
So I'm just trying to gauge what kind of lights you up about in terms of a vision.
Sure. As far if we wave a magic wand, John Rickgarn owns 3 apartment complexes or whatever. Looking at the cash flow, I'd say, yeah, sounds great. I'd still probably want to, be as hands off as I could. I mean, obviously, absolutely. I like the value add, I like equity, I like cash flow. For starters, I'm the last person to be the maintenance man. If I can pound a nail in straight, that'd be cause for celebration, but would still want to outsource as much as I possibly could.
Yeah, no. And look, by all means, anybody that's teaching in this area will tell you to have third-party management 100% of the time. I like that you are almost forced into third-party management by virtue of being kind of in different places on the map, right?
Yeah.
Because the 3 to 10% that you're going to pay for property management, usually it's going to be 7 or 8 if you're in a larger, if you're in a smaller property without payroll. If you're in a larger property with payroll, you're going to be at 3.5 or 4% plus payroll.
Okay.
But having that in place, having third-party management in place, you want your job to be the asset manager. So and you're probably already doing this with your current properties, where you have some regular meeting with the property manager. We meet generally weekly with our property managers. Okay. Although now that our properties are starting to be nicely stabilized, most of them are. We've gone to bi-weekly meetings, but we have KPIs. So we have a spreadsheet that they fill out with all the metrics from the previous week, showings, leases, advertising, all that stuff. And they basically just give us a report.
Okay.
And we look for red flags. We look for concerns. We of course encourage like transparency and honesty, and we love our two markets. We're in Columbus, Ohio, and Oklahoma City.
Okay.
And we love those two markets because of the level of property manager that we have in both locations. So yes, absolutely. As the operator, your job is largely the deal making, right? Like the deal sourcing, all the things that it takes to source a deal, broker relations, direct to seller marketing, whatever you're doing. And then you're finding deals, you're writing LOIs, you're getting deals under LOI, and then you're working with attorneys, you're getting a PSA in place. And then once the PSA is in place, you're doing usually 30 days of, somewhat intense due diligence. Of course, you have an inspector inspect it and that sort of thing, but you're doing some high level financial due diligence on the property. And then you're also, and this is a huge piece, you're also putting the capital together that you need to get the deal done. And you're sourcing the loan, right? So you're working on the loan, and then you're putting your capital raise together, and there's alternatives to that, right? Like you can work with a co-GP, or a few co-GPs that mainly are focused on capital raising. They have to have other tasks on the GP, but they raise capital, and there's ways of sourcing equity that don't involve grassroots capital raising. But and then from there, it's just getting to the closing table and getting ownership of the place, and starting the asset management process. And there's a lot of little things in there. There's an asset management plan that we write, stuff like that. So that's kind of what I mean by being an operator. And look, like you mentioned investing passively. That's brilliant. Like these passive investors in our deals, for instance, and I think we're pretty standard as far as returns and splits and everything. Our investors make a 7 to 8% preferred return, meaning they get paid first before any other investors get paid. And then they make a 70-30 equity split on any additional cash flow and on the back end profit, which is where the bulk of your cash, that's where you really gain your wealth, right?
Yeah.
That's where you're building wealth. And so they get paid first, and they get paid more than the GP, and their only job is to deploy funds. So that is and it's a wonderful way, in my opinion, of getting into larger scale deals, because if you work with somebody like me or other syndicators that are really value focused. Sorry, I don't know if you can hear the dog scratching herself.
Oh, actually, I can't. No.
She's just making all kinds of noise. But when you can get into a syndicator, working with a syndicator that will include you in, say, asset management meetings, GP meetings, email chains, and like really bring you along for the ride, and so that you get like a front row view of the whole deal and everything from soup to nuts kind of thing, that can be like super valuable if you want to become an operator at some point. But there's a lot of people that just make a mastery out of being passive investors and with good syndicators, and man, there is nothing wrong with that path at all.
Well, and I look at it too with the syndicators, and I've networked with quite a few. I've worked with and invested with some over the years too. I mean, they have they've probably forgotten more about multifamily syndication than I'll ever know. So I figure, well, they got the expertise, they're in need of funds. Well, I can provide the funds, but versus myself taking 3, 5, 10 years to learn what they know, it's like, well, how about I just leverage their expertise and then provide the funds? And it's a win-win for everyone.
Yep. That's it. That's the name of the game right there. And, we work with passive investors. We have passive investor partners on our deals, and we syndicate, and we've got some happy investors, and they're getting quarterly preferred payment returns that are pretty nice, like nothing to sneeze at. So, and then how they'll do at the end is really great. One thing I wanted to highlight from something that you said was, it sounds like you've got a fairly significant amount of equity in your current portfolio.
Yeah, correct.
That's true. Yeah. So yeah, that's definitely like dry powder, right? Like it's as close to, it's not liquid obviously right now, but it's really close. One thought I had for you, and I don't know if you've looked into this, is what about taking HELOCs on the properties?
I have looked into that. I've worked with or talked to a few lenders. Some of them are, like the ones I work with at the local bank won't touch our out of state ones. Okay. But I've, opened to other networking, opportunities. Probably the biggest one right now that probably has the biggest chunk of equity is actually our condo in Tucson, which, I mean, if anyone's followed Arizona, the values have just skyrocketed. Yeah. And ironically, in 2021, we did a small cash out refi, locked in 30 years at 2.875, 2.875, excuse me.
Nice.
And it's like, okay, 30-year fixed, that's a short-term rental. I'm not paying that thing off early. But I mean, hindsight 2020, I should have waited till this year to do the refinance. So
yeah, right. Yeah. Well, okay. So yeah, I mean, even with higher interest rates, like, if you're paying 6, 7%, 7.5%, you look at just a passive investment opportunity, and, the average annual return on a 5-year deal is somewhere in the, in the high teens to low 20s on a good deal. And by the way, I think those are the deals I think the IRR, the internal rate of return, should be at least 15, 16%.
Agreed.
If not higher. And, so those are really the metrics you want to be looking at. So, I mean, you can see the arbitrage there between the cost of the HELOC and the revenue and the profit you'd be making. So there's lots of ways to access equity, right? I mean, sell the property, refi the property, get a HELOC, get a line of credit, use it as collateral on other, just apply for a loan and put up one of your properties as collateral. That's very real as well. But I think if I'm in your shoes, just thinking from your perspective, I would be working on actively freeing that equity up. Because here are my thoughts overall is, I think there's going to be in the next 3 to 12 months, some really great opportunities, especially in the small multifamily space, the mom and pop owners that own 12 units or 20 units or 40 units. That space is going to be, there's going to be some interesting stuff happening with notes coming due, notes adjusting. Yeah. People just generally being undercapitalized and the economy hurting, et cetera. And then there's just always, no matter how healthy the market is, there's always mom and pop owners that just haven't kept up with rents.
Yeah.
And so, no matter what the economy is, and especially now that's the case because we just went through such a rapid rent growth cycle that mom and pops that aren't in touch with that or don't have their finger on the pulse and really keep up with that. Like,
yeah.
Plus they've got kind of soft hearts for some of their long-term tenants.
And I don't want Mr. Smith to leave. Been such a great tenant, and I don't want to raise the rent.
$400 a month for his 2-bedroom. Yeah, totally. So anyway, my thoughts are that you start to do the things that, well, frankly, I teach people in my coaching program to do, which is keep branding. You've got a nice brand, dude. What's the W stand for again? I'm looking at your background.
Sure. It stands for wealth.
Wealth Freedom Nexus.
Yeah. So the entire website and podcast is Wealth and Freedom Nexus, or what I call the connecting point of true wealth and freedom. I wanted to do more of a focus on the freedom space, and I was trying to find a little shorter, you know, Instagram tag, YouTube tag, etc. So it's like, well, let's just shorten it to W Freedom Nexus. So
there you go. That works. Yeah. And so guys, check that out on podcast, Apple Podcasts. Go to Wealth and Freedom Nexus podcast. Also on YouTube, Instagram, Twitter, and wfreedomnexus.com. Nexus is NEXUX. NEXUS.
If it's easier, you can just do my last name, rickgarn.com. They'll redirect to everything, because interesting thing about my last name, there's only 3 people in the world with that last name. So
interesting. That is very interesting. Okay. So just to kind of start to bring this full circle a little bit, I think what they're like, I'm just going to go through off the top of my head, because I have this all structured in my coaching, but I'm going to go through, I'll try to get all of them out, and I may forget one or two, but like the things that I think somebody in your situation, you know, can be doing to really advance the cause. The first one is going to be continuing to do your branding. You know, you really want to ride that brand. I would logo up. I don't know if you have one. It's not behind you right now.
I do, but that's just my Zoom background. So
yeah. So, and then you've already got the podcast, man. Like, that's huge asset. And you know, you're going to be able to leverage that a lot. So keep branding yourself through the podcast. And then, I would start working, intentionally on your broker relations game. And just to back up, I'm assuming that you've kind of chosen a market that you want to go after. I would recommend choosing one market, maybe 2 at the most, that you want to sink your teeth into.
Sure.
So I'm assuming that you have a market. Let's say, for the sake of the conversation, it's St. Louis, right? So you want to launch your broker relations game in St. Louis. Basically, get to know anybody and everybody you can in that space. Preferably, you want to tour properties with them, as opposed to going to lunch or coffee. Lunch and coffee is great, but like out touring properties is where it's at.
Yeah.
And then you also want to get your property management relations game going, and that's just networking. You know, pretty straightforward. And then you'll want to start thinking about capital raising. You know, if a $3 or $4 million deal comes along and you need to raise $1 million, like, you know, in a year, what do you need to build in the meantime to be able to do that in 6 months to a year? I highly recommend, and you may already have something like this, but having a landing page with a click magnet, some sort of downloadable asset where people enter their info. You have a CRM integration that captures their info, and then you have an auto emailer, you know, email people. That becomes your database that you market to. And building that is, you know, it's a little bit of a big deal. There's people that'll do it for you. I know of one really good firm that'll build the whole thing turnkey for you. And then and then from there, those are kind of your foundational pieces. I'm sure there's a few other balls you want to get in the air, but I think just to kind of round this all out, the biggest piece on this, John, and this is true with me, it's true with every wildly successful investor, but it's mindset.
Mm-hmm.
It's all about mindset, and it's about what the work that you do to essentially build the confidence and the self-identity that you are somebody that can pull this off. And I know you can, dude. Like, I can tell, I talk to people in this space, all the time on the show and off, and you've got what it takes, man. You totally do. There's nothing that anybody has or had that got started in this space that you don't have in place. And yeah, I'm sure there's people that have, started with big funds and stuff like that, but that's not what I mean.
Sure.
So, that mindset piece is like 80-90% of this game, in my opinion.
Uh-huh.
And it's not necessarily, it can be kind of hard work and kind of tough to take on, because you're basically, what you're doing is you're looking at limiting beliefs, right?
Yeah.
And you're looking at like what's getting in the way of what I really, really want for myself is this vision. What limiting belief is coming up when Tate says, if you could wave a magic wand and get 100 units, like what would, what comes up? Oh, I don't have what it takes. I don't have the money. I don't have the partners, and what, actually, I'll just go ahead and ask you that. What does come up for you?
Probably just I don't know. I don't have I guess like knowledge and expertise is probably the two big things that come to mind. It's like, the funding to me seems like less of a hurdle than the knowledge and expertise, at least in my book. So,
yeah. And dude, like, all of that is available. So anything that you're missing, think partner. Think I need a partner for this. And by the way, you may need another item to put on the list would be, you may need to start networking for a key partner or a sponsor.
Sure.
For loans. But like, you can partner with somebody, give them, dude, the first deal we did, or second deal we did, we gave this guy who is just a big multifamily tycoon in Salt Lake City. We gave him 5% of our GP just to be an advisor.
Oh, wow.
Us. And so we could say, as he was an owner, he's on the general partnership, so he was an owner, and we could leverage his experience. And he ended up being the sponsor on the loan too.
Wow.
At the time. So and we've done like 5 deals with him since.
Interesting.
Yeah, it's really cool. So yeah, just so some things to be thinking about.
Sure.
But I would say this, John, I coach people one-on-one. I have gurus on the show all the time. Like, you got what it takes, dude. You're poised to really go, eventually as big as you want to go, but I think you're poised to go bigger sooner than you realize.
Okay.
Is the feeling I get.
Right.
So, and look, coaching, mentorship, like, it can accelerate the curve and the trajectory massively, and it can help you avoid major mistakes. So that's something to consider as well. There's some great coaching programs out there. Jake and Gino's is one of the ones I like.
Familiar with them. Yeah.
Yeah, they're great. I love Gino. He's been on the show a couple times.
Oh, okay.
And I don't have any affiliation with them, but like, I frequently recommend their coaching program. Michael Blanc has a coaching program.
Sure, yep.
Rod Cleef. So there's there, and I
Brad
do
Sumrock, I believe. I think he does too, or something of that nature.
Yep. And there's masterminds out there. I do in-depth one-on-one coaching in this space. So something to like, whether that's a formal paid coaching / mentor or a, just somebody that really, this is more rare, but somebody that kind of takes you under their wing and wants you to succeed. Those are more organic relationships, and you can't necessarily go out and just find that. So
sure, exactly.
But dude, we're running out of time here. What a bummer. This has been awesome.
No, yeah, that actually went pretty fast.
Yeah, it did. No, this has been great. I think we touched on some important stuff, and I'm like, right now, as I'm talking, I'm just feeling really excited for you because I think you can make big strides here in the next 1 to 3 years.
Okay.
And that's one last thing I'll leave you with. Have you heard of the book Vivid Vision, or have you read it? Or
no, I actually haven't. So
it's a guy named Cameron HEROLD, HEROLD, and it's fantastic. It's a short read. It's kind of a guidebook to writing your own vivid vision.
Okay.
Which is a 3-year plan. It's a 3-year vision, 3-year mission statement, if you will. That basically captures like all the realities of your business and what you're doing. Your metrics, your culture, your team, etc. And you write it from a future standpoint of looking back over the next 3 years, if that makes sense.
Yep. No, it does. Yeah.
That's something else that I have my students do that I think could be great for you.
Okay.
And might expand things for you in terms of goals and vision. So
sure. That to my Kindle wish list.
Yeah. So listeners, connect with John. Wealth and Freedom Nexus podcast. Look it up on Apple Podcast or Spotify, whatever you use. Also on YouTube, and then on Instagram, W Freedom Nexus is, I'm assuming, the handle.
Correct. Yep. Same with Twitter. So
yeah, and same with Twitter. So, and then the website's wfreedomnexus.com. So, John, dude, this is great. Thank you so much for being on the show. I really appreciate it.
Yeah, thanks for having me on. It was great, Tate.
Yeah, I really enjoyed it. And please stay in touch and let me know if there's ever anything I can do for you. We'll partner if there's something good. We're here to help as much as we can. And so, so totally looking forward to seeing how things work out for you.
Yep. No, I definitely keep in touch. Thanks.
All right. Take care, John.
You as well.
And listeners, thank you for listening to another episode of the Apartment Gurus podcast. Appreciate you guys more than you know. And I do it for you. I do it for me too. I love this. These conversations like the one you just heard just light me up. And I love being able to help in even in little ways if I can. So hopefully you guys got a lot out of this, and we'll be back in another few days. We're doing 2 a week right now. So we'll be back in another couple days with the next episode of the Apartment Gurus. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.